The 50-year mortgage, good, bad, ugly. What about it? Now, if you watch the headline for the broadcast, I put in there, save $453 a month or lose $648,000.
Yep.
What is the truth of it? So here we go. Mortgage 101. You probably heard the buzz about a 50-year mortgages. Lower monthly payments sound great, right? But here's the question nobody's asking. What's the trade-off? Because that lower payment comes with some serious costs, and let me break down the pros and cons. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. Today, we're talking about this 50-year mortgage proposal that's making headlines. The White House and the Federal Housing Finance Agency are floating this idea to make monthly payments more affordable. But as I always say, strategy beats rate always, and the same goes for loan terms. So what exactly is a 50-year mortgage? Simple. Instead of paying off your home loan over 30 years, you'd stretch it to 50 years. Same loan amount, same over 2 more decades, or spread over 2 more decades. Now, here's something important. A 50-year loan typically comes with a higher interest rate than a 30-year loan. But for our example today, I'm going to use the same interest rate, assuming that we buy down the rate, which can be done. This gives us an apples to apples comparison. Let me give you real numbers. On an $800,000 purchase price, 20% down, that's $640,000 loan amount at a rate of 6.25%. Your monthly principal and interest payment on a 30-year mortgage runs about $3,939. Stretch that out to 50 years at the same 6.25% rate. Remember, we bought it down. It drops to around $3,486. That's $453 less every month. Quick note. These examples are for educational purposes. We understand that any loan offer will require full APR disclosure that includes all costs. Are you happy, compliance people? Now, $453 a month sounds nice. That's $5,436 a year back in your pocket. But here's what doesn't change. You're still paying interest on that money. You're still building equity slowly, and you're still taking on market risk. The difference, you're doing it for 20 more years. Let's start with the advantage because there are some legitimate benefits to consider. First, improved cash flow. That $453 monthly savings helps with debt to income ratios. If you're right on the edge of qualifying, this could make the difference between getting approved or not. Second, it's a potential bridge. If you have a defined short-term cash flow constraint, this lower payment could help you get in now with a plan to restructure later. What kind of constraints? The expiration of alimony or child support in a divorce agreement, the payoff of student loans, the end of a car loan payment. These are temporary obligations that will drop off, freeing up cash flow for a refinance into a shorter term. The 50-year term gives you breathing room during that transition period. Third, flexibility. When used as part of a broader strategy, not the forever plan, it gives you more choices. You're not locked into this permanently. You can refinance when your situation improves. And fourth, the payment relief is real. That extra $453 a month could go toward paying down high-interest credit cards, building an emergency fund, or handling other financial priorities that matter more right now than rapid equity build. We're creating some detailed examples of exactly how this works at rsrlinks.com/50-year. That's 50-year. rsrlinks.com/50-year. So you can see the numbers play out in real scenarios. Now let's talk about the downside because they're significant. First, dramatically slower equity build. With the 50-year amortization, your early payments go almost entirely to interest. On that $640,000 loan, after 5 years on a 30-year mortgage, you'd have paid down $47,000 in principal. On a 50-year, only about $26,000. That's a $21,000 difference in equity after just 5 years. After 10 years, the gap is even wider. You'd have around $104,000 in equity on the 30-year versus only $56,000 on the 50-year. That's nearly $50,000 in difference. Second, massive total interest cost. Over the full term, you'd pay roughly $815,000 in interest on a 50-year mortgage versus, I've got the numbers wrong in here. Wait till you look, they look the same. No, that's because 30 years stop. Oh, okay, I get it. $815,000 in interest on a 50-year mortgage versus $815,000 on a 30-year mortgage. Wait, those look the same. No, that's because the 30-year stops at 30 years. The 50-year, you'd pay an additional $648,000 over those extra 20 years. We're talking about paying more than your original loan amount in interest alone. Third, regulatory and availability. Right now, this does not exist. It would require major changes in underwriting guidelines and secondary market rules. So we're discussing a concept, not a current option. Fourth, the affordability illusion. Lower payments might tempt you to buy more house than you should. If you're stretching to afford $800,000 because the payment fits on a 50-year loan term, you might be taking on too much risk. So when does a 50-year mortgage actually make strategic sense? It makes sense when you have a clear exit plan, not hope, not maybe, but a defined refinance strategy with specific triggers. It makes sense when you value cash flow flexibility today more than rapid equity building. When that $453,000 monthly savings solves an immediate problem and you have a plan for using it productively. It makes sense when you're in a stable market and you know you won't be in that home for the full 50 years. The term becomes your safety net, not your plan. It makes sense when you intend to use the extra cash flow strategically, paying off high interest debt, building reserves, funding a business, not the new boat payment. And critically, it makes sense when you commit to monitoring and acting. When your income increases, you refinance. When a debt drops off, you shorten the term. When your home value rises enough, you restructure. On the flip side, when does it not make sense? It doesn't make sense when you plan to stay long-term, build wealth through equity. If this is your forever home and you're counting on that equity for retirement, the 50-year term works against you. It does not make sense when you have no exit strategy. If you're thinking lower payment is just better without any plan to change later, you're setting yourself up for disappointment. And it doesn't make sense in a declining or stagnating market. Slower amortization means more risk if home values do not cooperate. It doesn't make sense when the interest rate premium for the 50-year term makes the payment savings trivial. If lenders charge a higher rate for the extended term, run the numbers carefully. That's what we do for you. And it doesn't make sense if you're using it to justify buying more house you can really afford. That's not strategy, that's risk. Here's how I'd approach this if it becomes available. First, run both scenarios side by side. Look at the 30-year and then the 50-year. Not just monthly payment, but equity build after 5 years, 10 years, 15 years. Total interest costs, break-even points. Yes, I did that for you, rsrlinks.com/50-year. Second, define your exit triggers up front. What has to happen for you to refinance out of the 50-year term? Income increase or of specific amount, debt payoff, home value reaching a certain point. Define it now. Third, evaluate it within your household blended interest rate. The 50-year mortgage isn't happening in isolation. How does it affect your overall debt strategy? What's the impact on your total household budget? Fourth, consider the opportunity cost. What else could you do with that $453 monthly savings? If you're using it to pay off a 22% credit card, smart strategy. If you're just increasing your lifestyle spending, stupid.
Such an idiot.
Yeah. And fifth, remember that strategy beats rate always. The term of your loan is a strategic choice. Make it intentionally, not accidentally. Bottom line, here's the bottom line on 50-year mortgages. It's another tool, not a silver bullet, not a disaster, a tool. Like any tool, it works well when used correctly and causes problems when misused. The key is knowing the difference. If you need a 50-year term just to afford the house, that's probably the wrong house. If you need it as a part of a deliberate strategy with clear milestones and a refinance plan, it might make sense. But don't fool yourself. That lower payment today comes at a real cost tomorrow. The question is whether that trade-off aligns with your bigger financial picture. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. If you want to understand your complete financial picture before making any housing decision, head over to rsrlinks.com/keysteps, rsrlinks.com/keysteps. That's where you'll find our financial house in order tool, get your credit analyzed, understand your household blended interest rate, and build a strategy that actually works for your life. Because at the end of the day, strategy beats rate always, and that includes the term of your loan. That is Mortgage 101, brought to you by rsrlinks.com/Sora.